Another possible skill that you might need is to be able to look at an inventory card and say whether that business is using identified cost or FIFO. So, can we actually even tell whether the business uses identified cost or FIFO just from looking at the inventory card? So if we took that inventory card, I'd expect you to be able to tell me, is that identified cost or first in, first out? So how would we do that? Well, the first thing is we make a really awesome cue card that looks like that. It's just missing inventory write down, but we'll deal with that yet in the next chapter. But it's got all the rules of what should happen when different transactions happen. So, and they're different except for a purchase return. That's the only one where if we look at it, we can't really tell whether it's identified cost or FIFO, but for sales and inventory, we should be able to tell because identified cost does one thing, FIFO does another thing. So if I gave you for sale, and I gave you those two inventory cards there, so we're looking at this one, so we've got two inventory cards, we're looking at the shaded section in blue here. This one says 23 out at 30, 2 at 50. This one says 1 at 190, 2 at 200. One of those is identified cost and one's first in, first out. How would we tell? Well, what we need to do is we need to look at the balance on the day before. So we take this top one. There was 23 at 30, 40 at 50, and then it looks like we sold 25 units here. And the first ones that went out were these top pile here, 23 at 30, and then we went down and got the next two from this $50 pile. So this one's got to be first in, first out. But this one here, if you look at the day before, there were 3 at 180, 1 at 190, and 8 at 200, and the one that went out was 1 at 190, so that's kind of the middle one here, and then the next two were from the bottom pile, so that is not first in, first out, that's identified cost. So there, just looking at the balance there in the out column, you can determine which system is being applied. What about for a sales return? This one, the actual unit is identified with identified cost. FIFO, we do the reverse FIFO until all units are returned, then move back to the previous price. So we've got two inventory cards again, looking at the transaction that's shaded in blue, which is which. Now to do that, we're going to have to look at the day before. So the day before there was 3 units at 180, 6 at 200, customer came and brought back 1. Which one? Well, not like under FIFO we would say the last one we would do reverse FIFO. So that if it was FIFO, the customer should have brought back 1 unit. We said that would be valued at $200. So that can't be it. And if we just look at this here, we can see the customer the day before bought 1 at 180, 2 at 200. Which one did they bring back? Well, if it was FIFO, they should have brought back the $200 one. We would have said reverse FIFO. It should be that one. So it's not that. So that's got to be identified cost. Whereas with this one, we can see here the day before, the customer bought 23 at 30, 2 at 50, and they bring them back 3. Which 3? Well, we'll assume these two, but they never bought more than that. So we'll assume we're at 38. We'll assume that if they only took 2 at 50, they can't have brought back 3 at 50. So that's all returned. So now we go back to the previous price, which is these $30 units here, and we'll put that there. So 1 came back in at 30, 2 came back in at 50. That's just reverse FIFO. So that would be the first in, first out inventory card. Inventory gains. With identified cost, we identify the actual unit, whereas FIFO use the most recent value from the in column. So let's look at this inventory card at the top. So here, got an inventory gain. Is this identified cost or is it FIFO? So we've got the date, we've got a memo, it's in the in column, definitely an inventory gain. 4 came in at $40. So let's look here. So the day before we had 5 at 40 and 17 at 50. So which is this? Is this inventory, is this identified cost or FIFO? Well, I'm just going to go to the FIFO rule. The FIFO rule says use the most recent value in the in column. Now the most recent value in the in column is $50. So if this was FIFO, the inventory gain should be $50 per unit. So this has got to be identified cost, this one. But as we look here at first in, first out, so we had 19 at 7, 50 at 6, 20 at 8, and we value the inventory gain here at $8. Well, that's because the most recent value in the in column is $8 here. So that one has to be the first in, first out method of inventory. And I think inventory gains are the hardest ones to interpret. So just make sure you got your cue card with the rules here. And then you just look at that, and then you look at the cue card, and you can apply, the inventory card, and you can apply your knowledge. Inventory loss. Identified cost will identify the actual unit that's gone. First, FIFO will just say the first one in was the first one out. So we've got our inventory card here, and here, let's look at this one. 30th of April memo. So yeah, inventory loss in the out column. Looks like we've lost 7 units. Which 7? Well, the day before we said we had 6 at $15 and 15 at 12, and it looks like the first ones we assumed went out was 6 at 15, and then the 7th had to have been from the $12 pile, so that's got to be first in, first out. Whereas with this one, the day before we had 2 at 180 and 4 at 200, and the 2 that went out are from the $200 pile, so that's not the first in. The first in here is 180, so that's come from the second pile, so this one's got to be identified cost. What about for drawings of inventory and inventory used for advertising? Well, let's consider them together because they actually look identical in the inventory card. We can't tell them apart because they will appear the same. So in identified cost, the rule will be the actual unit. But under FIFO, we'll apply first in, first out. So if we took, so this could be either drawings or inventory used for advertising, but I guess we want to know, is it identified cost or FIFO? So let's take this one. So 11th of April memo out column. And this one, 7th of Jan memo out column. So that would say they're either one of these two. But looking at this one, the day before I had 3 at 10, 60 at 15. And it looks like 5 went out for either drawings or advertising. And the first 3 that went out were at $10. So that's these 3 here. And then I went and got the next 2 from the $15 pile. So this one's got to be FIFO. This one here, the day before, I had 4 at 180 and 2 at 190. And we said 2 went out for maybe advertising or drawings, and we said 1 was from 180 and 1 was from 1. Well, if this was FIFO, we would have said both of these were valued at 180, but they're not. We took 1 from each pile, so that must be identified cost. So what we've learned here is that for every possible transaction that we've got, we should be able to look at the inventory card and just break it down and go, are we applying first in, first out, or identified cost to this inventory